What's up guys, it's Fred again. Welcome back to the channel and the hobby, and this time I'm bringing you my top stocks that I'm buying right now in May of 2021. And as before, instead of just throwing at you some random stocks, I'll be sure to provide the context in which I'm actually making these purchases in terms of the market conditions, the current events, and how they actually fit into my portfolio. Before we begin though, it would be great if you could just do me a very quick favor by extremely gently smashing the like button for the YouTube algorithm, and you can also consider subscribing to my channel for more cutting edge videos about investing. And with that, let's get started with the video. So first of all, for the format of this video, I'll give you a brief recap of some of the stocks I called out previously, as well as some of the situations surrounding those investments, as well as what my recommendations are for them moving forward. Then right after that, I'll transition into some of the stocks I've been buying more recently, as well as the current events and context surrounding those. And the first thing I want to mention is that all the FANG stocks, which are again Facebook, Amazon, Apple, Microsoft, Netflix, and Google, have largely surprised to the upside with their earnings, with perhaps the exception of Netflix. And as a result, I am indeed very pleased with my large positions in both Facebook and Microsoft, as well as my smaller positions in Apple and Amazon.
Nice.
And as such, I would be very comfortable and confident adding to each of these FANG plays, provided especially if we see some dips. Next, the very popular Tesla also reported earnings which reiterated its incredible growth in delivery numbers and revenue. However, the stock price did not react very significantly to these earnings, likely due to the fact that a lot of this growth has already been factored into its price. But with that, I'm still looking to add to my Tesla position somewhat aggressively as my top EV play and as just a well-rounded play in general.
Yeah. Oh my fucking god. Well, maybe that was a little too hard.
Not to mention, it'll definitely greatly benefit from President Biden's recent infrastructure plan, which will support electric vehicles, renewable energy, charging stations, and related infrastructure. Moving on, another significant market event that's been going on lately is the chip shortage that actually influences many of the companies I just mentioned and more. But of these, some of the plays that I think will benefit greatly from this in terms of its surprise to the upside with its stock prices are AMD as well as TSMC, which stands for Taiwan Semiconductor. And if you're wondering why I like all these stocks I just mentioned, I'm not actually going to cover that in this particular video because I've been going over them in a lot of my other previous videos, so you can go ahead and check those out. Plus, I also do some deep dives, and I plan to do some deep dives actually on many of these stocks moving forward.
Right.
But there's just one exception of a stock that I want to cover very briefly right now, which is from my previous video on Biden's infrastructure plan and the many ETFs and stocks that I think would benefit from that plan. And if you're interested in that video, it'll be linked in the description box below. But anyhow, the reason I want to cover this stock is that not only did it just have its earnings, but the stock price also saw a pretty drastic beatdown, which is also why I want to call it out as soon as possible. And with that, the stock and company in question is Enphase, ticker symbol ENPH, which is not only a household solar energy solution, but also one that has commercial applications. And in case you're not yet very familiar with their business, essentially Enphase is a nearly all-in-one solar energy solution, most known for their so-called microinverters, which is the part that combines with solar panels that makes them a lot more customizable and also a lot safer compared to especially their competitors. And besides that, they also provide batteries for solar energy storage, as well as a web-based app and software for users to track and control their power usage. Now, the reason I want to bring up Enphase again is that, first of all, it actually beat on its Q1 earnings for the most part, and yet there are certain metrics that people are perhaps focusing on that are making the stock price tank quite a bit. And according to what I've read from its Q1 earnings, the main headwind that it has against it is that it actually guided quite mildly for Q2, mainly because of the ongoing chip shortage. However, because I fully believe that this chip shortage will only be a temporary setback, as it also is for plays like AMD and TSMC that I'm also invested in, and mainly since I like to invest long-term, meaning that I don't really care about short-term opportunity costs as perhaps traders would, that means I'm more than comfortable with getting into or adding to a position as long as the overall narrative of a stock or company doesn't change, and that I also have high conviction for that stock. And how I would personally define high conviction is that the stock and company in question would also have to have certain uplifting and bullish factors that have yet to be priced into the stock as well. And so in terms of the upside that I believe Enphase still has, first of all, it's been promoting itself greatly in many territories outside of the US. And not only that, but because of the way Enphase's microinverters work, and remember, these are components that are integrated within solar panels that make them connected in a certain way that makes it very easy for people to expand and customize their solar panels, as opposed to the ways that other companies actually have these solar panels connected. On top of the fact that these microinverters actually make solar panels safer as well by reducing the overall voltage, I believe that these characteristics will actually make them a very sticky brand and that people will not want to switch off to other companies and will stay loyal to Enphase, which will, in my opinion, make their global expansion and integrations a lot more effective. And this phenomenon seems to have already been evident in the US as they continue to take market share from their competitors. Not to mention, Enphase also has a great advantage in their profit margins as well. Therefore, because of their competitive advantages, their tailwinds that have yet to be priced in my opinion, as well as the recent beatdown in the stock price that is a temporary headwind, I am personally going to be buying more of this company. And apparently it's not just me that holds this opinion because Goldman Sachs, JP Morgan, and Barclays have all recommended buying this dip. And just taking a very quick look at its stock price and statistics, it's currently trading at roughly $135 give or take, with a forward P ratio of about 51 and a PEG ratio of 2.06 and a price to sales ratio of roughly 21 or 22, which is still arguably a little bit on the high end even compared to its competitors. But like I said, with Enphase having a bit of a competitive edge as well with its expansion and stickiness, I still think that these metrics are very much justified. On to the next stock, we have one that Cathie Wood's very own ARK Invest has been buying up lately, and it's the social media company Pinterest. Pinterest stock price also saw a very significant beatdown from the earnings, of which I actually think the negativity is also greatly overblown. But first of all, as for what Pinterest does and how it makes money as a company and social media platform, if we take a quick look, Pinterest is a very straightforward image-based platform where you can save these so-called pins, which are just images, onto these boards on your page that each can serve a different purpose. And Pinterest itself, for example, can also recommend different trends to you, and it actually enables a lot of e-commerce type opportunities. And for instance, if I just scroll through some of their daily recommendations, it actually capitalizes a lot on certain trends and holidays and just current events, such as recently we have May the 4th, right, which is like Star Wars Day. And indeed they have a recommendation that is Star Wars related ideas, right? And if I just show you this recommended board here, or they have a lot of pins that are from or related to Star Wars, right? You'll see that Pinterest actually allows for the promotion, and users can actually do this themselves. They can create their own so-called pins, which are these images, right? And each of these pins can actually allow for an external link, and people usually monetize them by linking to their own website, which then promotes their own products or affiliate products even. And Pinterest also allows for very easy integration with platforms like Etsy, because people can design, DIY products on Etsy, and then they can straight up promote them using Pinterest, right? And Pinterest, again, makes it easy for these sellers to get a lot of exposure by allowing people to, or recommending certain trending topics to people, and people saving these pins to their boards, as well as sharing them and browsing other people's pins and so on and so forth. So it's very much a commerce-based platform that also allows for a lot of sharing and just idea gathering, which then turns into sales.
Why make trillions when we could make billions?
And thus, I'm very bullish on Pinterest, not only because of their heavy involvement and integration with the growing e-commerce space, but also because of its ability to sort of allow people to grow their purchasing options, so to speak. And if we actually compare this to Facebook, which I am also invested in, by the way, but what Facebook does really well is that it actually analyzes what people are already interested in and sort of funnels in on what, in terms of ads and their feed, right, to make them buy more of what they already like. Whereas Pinterest, it also does that, and it sort of judges what you like, but it actually allows for a lot more suggestions, in my opinion, especially being such a visual platform. And the fact that you can see so many different ideas and images at once on the platform is another another thing, right? Because of how straightforward it is, and down to how many images people can see on their page at once, their dimensions and their sizes, everything has been really streamlined and optimized for maximum exposure and sales on their platform. And also, like I said, Pinterest loves to recommend new ideas for people to buy, right? For example, I recently got recommended these backyard oasis furniture and accessory ideas, where if I wanted to build my own backyard oasis, and this actually does look quite appealing. So Pinterest knows how to, appeal to what people really like and expand upon that. And anyhow, this could also entail me buying a whole bunch of products, right? Because I would need a lot of stuff to build a backyard oasis, right? Not just like one thing. And by the way, Pinterest's main revenue source, similar to Facebook and other social media platforms, is ad revenue. And so based on what I just explained, as well as Pinterest's continually growing results and earnings, I fully think that Pinterest will continue to be a very hot platform for advertisers, especially if some of the other platforms become more expensive to advertise on, such as, Facebook and Google. Now, to address why the stock price was recently beaten down, most analysts believe it's because Pinterest guided for slower than expected user growth coming up, especially due to the fact that the world is reopening and that people are going to be less, supposedly, on their phones, on their computers, and on social media. But in my opinion, this is just a temporary overreaction, and looking at how quickly Pinterest is growing, the cash they have on hand, and the fact that they're actually innovating constantly on their platform and expanding it and partnering with different platforms such as Shopify, which will actually make it even easier to monetize the platform, I do believe that there's still a lot of growth and consistency yet to be priced into the company. Not to mention, if we look at their so-called ARPU, which stands for average revenue per user, even if their user base isn't necessarily growing as quickly, if they're able to monetize each user better, this could actually lead to a lot more surprise on the revenue front as well, especially if Facebook's recent earnings was any indication. And not only that, but I believe Pinterest still has a lot of international markets yet untapped, and that they'll be able to enjoy a lot of growth on those fronts as well. And finally, Pinterest's stock price is roughly $62 to $63 after that dip, which I've been buying up, obviously. And its 4P is about 50, and its PG ratio, though, which factors in growth, is only 0.34, which is actually looking quite good. Its price to sales ratio is 22.18, and looking at its balance sheet, it currently has over $2 billion in cash versus $130 million in debt, which is quite healthy indeed, which means they not only have a safety net in that cash, but also they're able to, if they want to, use that cash and spend it to grow and expand. Moving on to the next stock, here's actually a curveball for you. So I'm going to give you a clue and you're going to guess what the next stock is. So look closely because here is the actual clue. Alright, hold on. Maybe that wasn't enough information, so I'm going to give you a couple more clues. So like the other stocks, this stock has also been beaten down lately after earnings, and it is ARK Invest's second largest holding only after Tesla, and Cathie has indeed been loading the boat on it recently. And now, if you guessed Teladoc, ticker symbol TDOC, then you are correct.
Yes!
No!
And in my opinion, and the reason that I'm buying Teladoc right now, is that it's actually on a valuation basis close to what it was pre-pandemic, and yet it's actually done much more and proven a lot since then. But before we get to that, first I want to give you a brief explanation of what Teladoc does, especially with its recent acquisition of another company, Livongo. So first of all, some have actually likened Teladoc to a sort of Zoom for doctors, where patients can connect to healthcare providers right online. But Teladoc is actually much more than that.
Of course!
Because whereas traditionally patients would seek out doctors and therapists if they actually think they have a problem and if something seems a bit more urgent, with Teladoc they're able to get more convenient, persistent, and on-demand healthcare advice, which includes and is not limited to things like chronic disease management and just health coaching in general, especially with the recent acquisition of Livongo, which actually specializes in this type of online personalized health coaching and things like diabetes management, blood pressure management, and all sorts of health related care that is done right online. And this also includes mental health as well. And in terms of Teladoc's business model, it charges its members a visit fee on top of a subscription fee. And the reason that I believe Teladoc is currently on the undervalued side is that, first of all, it did perform quite well in its earnings, seeing over 430% year-over-year growth in adjusted EBITDA, as well as revenue growth of 151% year-over-year. But as for some of the pessimism that caused the subsequent sell-off, on top of the fact that growth stocks just haven't been performing super well lately, I believe that this can be largely attributed to, and this is actually similar to Pinterest's narrative that I just explained, and it's that not only are there signs of slowing user growth, but also with the reopening being somewhat imminent, that people probably believe that online solutions are going to be less needed as people are able to go out and physically to seek out doctors and therapists and the like. And on top of that, with the acquisition of Livongo being so recent and thus the results of that being still yet uncertain, and also the fact that that acquisition sort of screwed up the balance sheet, so to speak, in that there's actually a lot of costs related to it that has to be reported in their earnings and balance sheet that sort of skewed the earnings negatively. But I do believe that these are just temporary headwinds, where if telemedicine is here to stay, and I definitely think it is, and in fact it's actually probably going to grow tremendously. Plus, with Teladoc being able to offer many different types of healthcare advice and monitoring, especially with their recent acquisition of Livongo, I do personally believe that Teladoc is a great option to invest in, especially for the very long term, which I am definitely committed to. Now, if we take a quick look at Teladoc's current stock price and valuation measures, it's currently trading at around $158 with a forward P of negative 152, P/G ratio of 21.6, and a price to sales ratio of 17.89. And thus, on the surface, this can make the stock look a little bit more unappealing and expensive. However, do keep in mind that many of these numbers do actually factor in their recent acquisition of Livongo, which did incur a lot of costs and amortization. However, if we consider Teladoc's valuation using its price to sales ratio, we'll see that it's roughly the same as what it was actually pre-pandemic. And I'm pretty sure most people would agree that Teladoc has since proven a lot more, as well as the fact that there's going to be a lot of momentum going into telemedicine, as well as the hype for the stock as well, with ARK Invest picking it up and all that. And so I definitely think that Teladoc is actually an even better deal than it was pre-pandemic. And what's more, it is indeed a better company now, especially with its acquisition of Livongo. And finally, for the last stock I want to point out that I've been investing in, and this stock has actually become ARK Invest's 10th largest holding in just a span of a few weeks after its IPO. That was the clue. And if you guessed Coinbase stock, then you are correct. And that is indeed the next stock I've been buying, which has very much been involved in the recent cryptocurrency craze. But I have to mention that I am investing in Coinbase for the very long term of years, provided that the narrative doesn't really change surrounding cryptocurrencies and their business model and their revenue growth. Because, and especially in the shorter term, since Coinbase's performance and popularity will be closely linked to how well cryptocurrencies do. And don't get me wrong, I am very bullish and optimistic on the future of cryptocurrencies as a system and technology, but there is going to be that volatility associated with most cryptocurrencies, right? As history has indicated, which may not be as guaranteed in the future, but that's something we can expect, which will definitely also reflect into, again, more in the short term, Coinbase stock. Speaking of which, and also getting into how Coinbase actually makes its money, it is primarily through transactional fees with people buying and selling cryptocurrencies on their platform. However, on the other side of this coin, since nearly 90% of Coinbase's revenue as of 2020 at least has come largely from transactional fees, albeit there was a bit from services such as storage and analytics as well. And thus some would argue that if, say, the prices of cryptocurrencies like Bitcoin and Ethereum start to drop, and if, say, that results in less interest and trading volume, then that would definitely greatly impact Coinbase's revenue, which again has largely depended on that transaction fee. However, despite this, I'm still quite confident in my investment into Coinbase, especially over the long run, given the popularity and increasing momentum of cryptocurrency as well as its adoption. On top of the fact that even going by fairly conservative measures, Coinbase is still projected to grow tremendously over the next few years. And not only that, but I'm also very confident in Coinbase's ability and potential to capitalize on other ventures besides just relying so heavily on transactional fees for their revenue, right? Such as incentivizing people to store more cryptocurrencies on their platform via interest payments, and things like facilitating and making more accessible digital payments, and also even things like NFTs and any sort of new technologies and systems associated with cryptocurrencies. But one final thing I had to point out is that since I consider Coinbase as more of a speculative investment, I actually allocated it within my portfolio according to that risk and my risk tolerance. For example, Coinbase is currently sitting at around 1% of my entire portfolio, slowly increasing as I average into these dips. And also, if the company proves itself and the cryptocurrency market proves itself more and continues to, do so, I'll actually start buying more and adding more shares of Coinbase. And that'll be all for today's video. Remember, you can pick up to 3 free stocks valued up to thousands of dollars from Robinhood and Webull using the links below. And with that, thank you so much for watching. Like the video if you liked it and found it helpful, and I will see you in the next video. Peace.